Silver Dave here, coming to you with another video about gold and silver. Over the last few days, gold and silver has been moving downwards. Are we going to see new lows or are we going to see it go higher? Well, let's find out. So a bit of a disclaimer, I'm not a technical analyst, I'm not a financial advisor, I'm just going to show you some things I found and my opinion of how it is. And it's really just like, I'm a beginner at technical analysis. I'll tell you straight out of the bat, I don't know everything. I don't know I don't know if I'm right, I don't know if I'm wrong. And you know, I did a bit of research and I wanted to see really if potentially, you know, we could see lower prices of gold and silver because, like I said, I did a previous video before. I think we're in a bear market, and I think we're going to see, at least in the short term, before 2021, we're going to see lower prices, and potentially we're going to see a crash of everything. And it's good to have a bit of cash on hand before we see a rise of precious metal prices. So, what do I have here? Well, I have printed today's gold price chart, and from you can see it went down, and we are at the 1860 level. And I believe a lot of the technical analysts out there are saying that the key resistance level before we see more sell-off is 1850, somewhere around there, 1845. Depends on the analyst, but it's somewhere around the 1850, the mid 1850 range. Okay, we're close to there. Do I think we potentially can go closer? Well, if I take, let's say, the 2-day exponential moving average and I compare it to the 4-day exponential moving average, right? I'm taking 4-hour periods and I'm comparing the exponential moving average between a longer term and a shorter term. Potentially, I'm seeing that in the short term, at least, we have an acceleration of gold price drop. So there's more sellers joining the market in the short term, much faster than previously. Does that mean we're going to see another crash? Maybe, but I do have to point out, like when I look through the graph and I look through how gold performed previously in, like I would say over the last, not during this year, but before 2019 and after 2010, it was relatively stable. You never saw so much volatility. You never saw this range of volatility that we have here. And I do have to say, if you take it into context, if you ask yourself, has gold crashed or not in 2020? I can say that yes, we've seen a crash. We saw gold rise spectacularly to above 2000 levels, and it came crashing down. It came down to, in September, to the 1800s level. That's almost a 10% adjustment in price. That in sort of like stock market terms, that would be a crash. In gold terms, that's a huge crash. Like for gold, that is a huge crash. The question is, do I think we're in a long-term bear market or not? And I don't know. So I decided to look at some indicators, and I was trying to educate myself to see what type of technical indicators are there. Of course, you have the different shapes, you can look at triangles and so on, but really technical analysis looks at figures and they look for trends, and what you're really looking for is for an acceleration or deceleration of the change in price. And why is that important? Well, if you have an acceleration, let's say upwards in the short term price change, that is an indicator that there are more people coming into the market buying relative to people selling. So potentially that could lead to a upward swing. The opposite is also true. If you have a deceleration, right, in price, let's say you were before accelerating and then suddenly all of a sudden, let's say here, you are accelerating, but then you suddenly see that there is a deceleration of price, a very quick deceleration of price, and your deceleration increases, and it goes, I would say it decelerates more than your longer term exponential average. that is also an indicator that all of a sudden you have more sellers than buyers. And that means that potentially in the short term, you will see a downward adjustment of the price. So now that's out of the way, at least that's what I understood from reading how a lot of these charts are read and how you would read the different sorts of moving averages. And of course, there's importance of shapes and so on, if shapes can lead to predictions. I'm not so much against shapes. I just, when I look at it, I've seen that shapes tend to go both ways. You know, you can see like people tell you, oh, there's head and shoulders, there are triangles, and they lead to an upward swing or downward swing. Yes and no. Like shapes are easier to like read and see, but the harder part that I've seen that's more consistent is the acceleration of the exponential moving average, the change in direction, and the change in speed of the exponential moving average versus the change in speed of the longer term exponential moving average of a longer period, usually double the period you're measuring. So what do I think is recently happening? Well, I think that like recently we've seen quite a few crashes of gold. We've seen it go to the 2000 level, crash back down to the 1850 level or lower, and then we saw it try and rise back up to the 1960 level, and then it crashed back down to the 18. So its trading was in the range. And we can see that at least within this week, I think gold is going to trend downwards because I see that in the short term, at least over the 2-day exponential moving average, we're seeing more sellers of gold. That means people selling off gold and probably picking up dollars. And they're selling off faster than historically. That means not 24 days, but 4 days before. So there's an acceleration of the rate that people were selling gold. Do I think that potentially we will have a reversal? That means it will go back up. I don't know, but I do know that in terms of the indicator, so I like printing out this indicator, is that our stochastics are very low. It means that we are potentially in what they call oversold territory. It means that we've been moving in the negative range further from the average at a much faster pace than expected, and it is potentially an indicator that we are being oversold. It doesn't mean that there's a reversal from a bear market to a bull market, but it does mean that gold at this moment, there's a lot of sellers of gold and people are almost dumping gold because when you have such low numbers, that's what it indicates. It means that we've been moving downwards very fast, and that is a sign that there's a lot more sellers. But what I find interesting actually is also that this MCAD oscillator, which compares the exponential averages over time and basically is an indicator whether the short term, the movement is faster than the long term. What we're having in the 9-day period is that, you know, it's almost flat. It's as if that the whole indicator is slowing down. That means the sell-off in the bear market that we saw previously is slowing down, at least I would say in the midterm. In the short term, at least this week, it's accelerating. But in the midterm, it seems that overall it's somewhat slowing down. And I was thinking, okay, are we seeing a bottom? And this is what I'm thinking. I'm thinking that we might be seeing a bottom because if you take everything relatively, we've already crashed over from 2000 to 1800s level. That's a $200 gold crash, right? That's a lot for gold. Gold typically does not go through that type of adjustment so fast, at least over the period of a few months. It's very rare, and I think we've seen but also to put it into context, it's very rare to see a massive rise in gold like we saw between the period of July and September. Like that type of acceleration is also very uncommon for gold. What do I think is happening? I think that we are in a bear market. We were in a bear market at least since September. That means that the price of gold was trending downwards. It was trending downwards from the 2000 levels to the 1800 levels. But potentially, at least in the midterm, we're going into oversold territory. Because if I look back, let's say I think a week ago, like I was looking at the same numbers, right? And I was saying to my viewers, I'm not too worried about the price of gold, but I think we're going slightly into oversold territory. And because I'm seeing that the stochastics are indicating that we're close to like a oversold territory. And it's true. If I look at it again, like I see that the raw stochastics are going down, and I can see the stochastic around 20%. And I can see that actually all of my oscillators, they're still in the negative, which means that it's still trending downwards, but they're trending less downwards. It's kind of like if I was to compare this to a car, right? I see a car driving down the street, and I saw it an hour ago, and it's driving it at 100 miles an hour. And if I look at it now, it's driving at 50 miles an hour. I can assume that between the 100 miles and the 50 miles, it's slowed down. This is an indicator when I compare 2 points in time of the two MCAD oscillators, the values, right? I can see that right at this moment, there is somewhat of a slowdown of the bear market, sort of bear market indicators of gold. Does it mean that we won't we will come out and there'll be a reversion? No, maybe not. Like, I don't know. Reversions are hard to predict. At least from what I understand and what I read, is reversions are pretty hard to predict, and nobody tends to get it right perfectly 100% of the time. There's always errors. People always make mistakes on reversions. And I also mentioned in the previous video, that we have something called survivor bias, which means that we tend to, maybe there's 100 analysts and only 5 of them predicted the reversion. We tend to believe that those 5 people will be right also the next time. That's called survivor bias. And in this case, I don't know. The indicators say that let's say the amount of sellers, at least within the midterm, is slowing down relative to a week ago. Does that mean that we'll go down further? I don't know. I think potentially there is something that can explain it. Fundamentally, people are expecting stimulus. At least when July happened, right? June, July happened. People were not expecting the Federal Reserve to step in and do so much QE. And that expectation made people believe that there would be massive amounts, like almost 3 to 4 times the amount more QE than currently there is right now. And what the Fed has done is they did their QE, they injected $3 trillion into the money pool. And then what happened was they didn't. They stopped. And they said, we need fiscal stimulus before we continue to do more. So then people were like, okay, I mean, it's obvious. The economy is rock bottom. It's a dark pit. People are getting fired everywhere. Like, Republicans and Democrats will definitely be able to work together and get a fiscal stimulus package out. Maybe. I think that was a bit of an optimistic, and people were like, yeah, because obviously, this is an event that brings people together. The economy is down the drains. They will put aside partisanship and get a deal struck and spend for the good of the country. No, they didn't do that. And I think that, in the short term, it's not great for the price of gold. There's no stimulus. Because the price of gold is pretty much correlated with an increase in monetary supply. You can't lie about that. If monetary supply increases, the dollar typically weakens a little bit, and gold prices tend to rise because it's priced in along with the dollar. What we don't know right now is how the dollar will be priced in the future, right? People believe that potentially there is stimulus. I think there will be stimulus. The question is how much and in what form will it come, and how much QE will the Federal Reserve have to do? And I think it's pretty clear that the Federal Reserve is ready to do QE. But it also realizes that if it just does QE, it's going to lead to purely asset inflation. Like, the money needs to go into the hands of people to spend to reboot the economy. In order for that to happen, they have to finance the government, and the government has to get a spending plan out to how to get this money into the people's hand. And right now, distribution of money is kind of a ideological thing. It's not really economics. It's ideological. So obviously, when it comes to ideology, neither Republicans nor Democrats can agree on anything. So there will be no stimulus. And I've seen a few people on YouTube shave their heads because they made a bet that stimulus would come, and now they have bald heads because it didn't come, and they're all bald. So, so in the end, I think really it's yeah. I don't know. I don't know if stimulus will come. I can't predict what Republicans and Democrats are going to do. I think when it does come, potentially we will see a massive rise in the price of gold and silver and precious metals. But before, as long as they drag it out, the longer they drag it out, the lower gold and silver will go up to a certain point, mind you. I don't think it will go below what the price was priced in before the first QE session this year, which is around the 1750, 1800 levels. If you bought like at the 2000 levels and then you're expecting to go even higher, you're going to get burned. That's why I tell people to never go all in if you want, but the time you want to go in, ease into it slowly. Ease into it like, one rooster at a time, 20 Swiss franc at a time. Ease into it with a few ounces of silver at a time. Don't just go in all in and expect like, oh yeah, it's just gonna go up forever. No, you can't do that. You have to ease in slowly. You have to cost average out. And if you're cost averaging out and your cost average is relatively low, let's say you're around 1800 like I did for gold, even if it goes to 1750, you're not too worried, right? I mean 1800 Swiss francs, which is slightly more than $1,800. But also I'm looking at the Swiss franc as if it was on discount, because really the real reason why the Swiss franc is so strong, and it tends to stay only temporarily strong, is in periods when there is uncertainty. And you buy, so if you have Swiss francs in periods of uncertainty and you see other assets out there that are relatively cheap for the Swiss franc, and you've had a lot of Swiss franc and you have monthly revenue in Swiss franc, it's a good idea to start buying a little bit of here and there, everywhere. But that's my position, and that's where I am. I do tell people I don't put everything into gold and silver. I clearly keep money on the side, and I keep roughly 6 months of cash reserves. This is reserves that I do not touch, and I usually try to see how much debt I have and how much I can already take away from the 6 months to allocate towards future debt payment. So then every single 3 months I do a review and I try to rebuild up to determine how much money I need to put aside to rebuild up to the 6 months cash reserve. Currently, I'm going to hit target this year. I'm on target for everything this year, but other than that, I need to do the planning for next year and so on. So what do I think will happen with gold and silver? Well, if you're a long-term stacker, I don't think you have to worry too much. If you're looking at stacking for 30 plus years, gold and silver tends to hold pretty well over very long periods. Do I think you can get a better deal in the short term? I think in the short term, you can wait a bit. There's nothing wrong with waiting a little bit. You won't miss out too much. Gold doesn't typically shoot up a lot. I mean, it's very rare for it to crash a lot, but it's also rare for it to shoot up a lot. But we did see a massive moonshot almost here. It's pretty impressive. It's been very volatile over the past, I would say, month, but we've seen extreme volatility all over the market. And today I'm seeing that the markets are all kind of turning red. So I'll be a little bit careful. I think we're going to see a little bit of a crash of everything. And then we're going to see potential reopening and reversal of everything pretty soon. Because I think all the markets are waiting for stimulus. They were all expecting stimulus. And I think the hope of having stimulus this year is completely gone. And then you have the Christmas period. you have a whole period, everything goes into a frozen like sort of state. Especially in Europe, during the Christmas period, most businesses are not operating. It's the before pre-Christmas period, right now, that they have the most sales. And I think most sales forecast for most businesses is not so great at this moment. So most people are pricing in the fact that they will not have a great year. And they will not have a great report at the beginning of the next year, which is the Q4 report. And I think once the Q4 reports come out, we're going to see a sort of a consolidation of a downward trend for all markets. And typically what happens is it stays relatively low. Gold and silver moves downwards slightly, but less than the rest of the market, but it tends to rebound faster when there is stimulus. And that's when, that's a great moment for gold and silver. But at the same time, I don't really know where's the bottom. I can tell you already, I don't know where's the bottom. I don't know where's the top. I can't tell you. I mean, if I did, I would not. I mean, if people could tell where is the bottom, where is the top, everybody would be a billionaire. Like everybody. But I don't know if you watched the movie about in The Wolf of Wall Street, like the very first scene. Where Matthew McConaughey is with Leonardo DiCaprio, and Matthew McConaughey was saying, "Yeah, it's all like fairy dust. Nobody knows where the market is going to go. Nobody knows. Nobody knows for sure. Like people can have a decent idea, but nobody knows for sure where it will go. Even if I tell you, like right now in the short term, there's more sellers than buyers, and we're currently seeing a change in the direction of the of the exponential moving average, at least the short term compared to the long term. This doesn't mean that like it will keep on going. It potentially could. And usually people, when they look at it, they look at how fast it's changing and they decide like maybe we're approaching a crash, and they can decide to close off their profits. Sometimes people do that. But sometimes it's not true. Like it goes down and then there's new news that comes in. Like I said, if you want to smooth out volatility from news, you cost average things and then you buy the average over a long period of time. And that's how you manage to stay, like I would say, somewhat protected. It doesn't protect you absolutely from volatility. Nothing does. But it does protect you somewhat from fluctuations, at least within a certain range. So yeah. So am I buying more gold? Yes, I have more gold coming in. I have a little bit. I'm not buying 1 ounce at a time. I'm buying like 7 grams, 5 grams over a period of once every single 2 weeks, 3 weeks. I'm buying a small quantity, bit by bit, and easing into the few ounces per month. There are times when I see that it's on the very low. I bought some, I believe, here. I bought some here. I bought a little bit. I bought less here, and I bought a little bit around here. So slightly at the 1870 level, I bought some, but I might buy some more if I see it drops below 1850. But I wouldn't buy like a lot. I would buy just a little bit, and I would see where it goes. I'm not too like worried, and I'm not too, because I know that even if this goes to like almost zero, I still have good enough cash flow that I don't need to sell it to bail myself out. That's what you have to think about, is that yes, gold and silver is for the long-term wealth preservation, but you have to be able to survive the short term, which is why I tell people you need cash. I'm not the only channel that tells people you need cash for the short term. I think there's quite a few other channels that tell you to stack a little bit of cash for the short term because it's a good idea, because you're a living, breathing person and you have fixed costs like rent, food, hygiene items. You might need soap, you need shampoo, you have to eat, you have to travel, you have to go to work, you have to pay petrol. in travel, like less long distance travel, but commute, if you're trying to work or you have to go to interviews for a new job, if you got laid off, these all involve some initial expenses. And you need cash to be able to be liquid enough to survive the short period, right? Of course, in the long term, cash never survives. That's why, cash is not a great long-term wealth preservation item. Anything else is better in the long term than cash. But in the short term, you need to have a good enough cash flow. And for me, I think for an individual, you're not a business, you cannot just go and levy funds and so on. For an individual, I think having 6 months of cash flow, that means to be able to meet all your cash obligations for the next 6 months, is a good measurement. Usually businesses, they tell you have a 3-month free cash flow, but larger businesses, they also have a lot of assets that they can sell off to free up free cash flow, or they can use those assets and borrow against those assets. As an individual, you typically do not. You could. You could use a pawn shop, but pawn services are terrible. They charge you. They only give you like a fraction of what your asset is worth, and they charge you a horrible interest rate, which probably, yeah, most people who pawn off things, they're never able to buy it back. It's very rare that they're able to buy it back, especially in economic hard times. That's how a pawn shop, during economic hard times, they are able to accumulate a lot of assets for very cheap, and they take very little risk because if the person comes back, they can get their item back and they get cash, and they make a profit too. But during the economic upturn, pawn shops typically are able to wholesale off a lot of the items they got on extremely cheaply for more. And pawn shops typically during periods of economic booming time, they stack cash. And when the downturn, they use that cash to accumulate assets. And then when the economy comes back up, they liquidate their assets. And they're able to raise more cash, and they rinse and repeat, rinse and repeat, rinse and repeat. Basically, they sit in a counter cycle to the overall, I would say, economy. And in some ways, you should probably think a little bit like that. Is that during times when things are going well, which kind of is a little bit late to say this, but just looking backwards, you should have free cash. And when things are you're thinking that maybe it's going to turn around, you should liquidate your free cash positions for a little bit more. How would I say it? For a little bit more. You should liquidate your assets for if you have assets for free cash positions, and then when the market turns down, you should try and look for buying opportunities. That's what I'm saying. And have I done it? Yes. Before the current downturn, I liquidated, I think, some of my assets. So I freed up a little bit of free cash flow, and I put that to the side. I put that to build up a little bit more than 6 months worth of obligations. Actually, I have close to a year worth of free cash, and that 1 year worth of free cash, I'm just holding it there. I'm not really doing very much with it, but it's there. Now, am I going to invest immediately half of it? No, it doesn't mean that when there's a downturn, I'm going to put all my chips on the board at the same time. I'm easing in slowly. I've eased in probably like 1 month worth of cash flow into precious metals, and then I might ease in another month and another month of my incomes worth into precious metals. So I'm doing you can see that my stack is building, like it's growing, right? But you have to remember that while I do wish that I had to have a 1 ounce buffalo, but a 1 ounce buffalo, like I said, is expensive. So I'm breaking it up. I have to buy 1, 2, 3, 4. I have to buy 3 of these and 2 of these to make up almost a little bit more than 1 ounce. And this I do over 2 months. This is over 3 months, and then I have a little bit more coming up. So, every single month I am easing into 1 ounce, but I'm not doing it at a single period. I'm doing it slowly. It was a little bit, actually it's 4 months. So yeah, 4 months I'm going to be, by the end of this month, I would have got my 3rd ounce of gold. And I've been buying pretty much near the bottom of the price. In terms of, I'm not buying at the very top for physical gold, but I'm not buying at the very bottom. I'm buying closer to the 1870 range-ish. Am I overpaying for my gold? I think physical gold has a 5%, 6% premium on it. It's less than silver, at least for me. And it's within the band of what I think I would be paying. If I was to buy the same amount of gold right now, I would be paying roughly the same amount. I would be paying maybe like $100 less today if I was buying gold just right now. If I was buying gold yesterday, it would be roughly the same. If I was buying today, it'd be $100 difference. Is it good or a bad thing? I think it's normal. It's normal. Like, it's within the range, the normal range. Do I feel like I should have waited longer? Well, yes and no, because you don't know which way the market goes, right? Potentially before the vaccine crash, like right at that moment, a week before that, they could have agreed on a fiscal stimulus, and then you were seeing this graph, like, even though they have vaccine, it would just go way up. It will break 2,000. If at this point, like, let's say the Pfizer vaccine, they say that like has 90% effectiveness, but it will never be delivered. And there's going to be a massive fiscal stimulus into the market. We might see it go above 2,300. This is the thing, you don't know. You don't know what the news or the future is. You can only make the best educated guess at this moment. And the best educated guess at this moment, I think, is we're not going to see stimulus. So we're going to see a slightly more downward adjustment of the market. But we still have a lot of uncertainty. We have global uncertainty, we have election uncertainty, we have worldwide sort of virus. Because even though we have a vaccine, a theoretically tested vaccine, you have to understand that this vaccine only has clinical data for 2 months. And normal vaccines, before it's approved, they get 2 years of clinical data. So it takes time, not because it takes time to find the molecule or the protein that would cause the immunoresponse. It's, you need to collect data over time, and you cannot compress time. You just can't compress time in many cases. It's an irreducible, I would say, quantity. And right now they're not doing it. They're saying that after 2 months, they're going to emergency approve the vaccine. But at the same time, we don't know what happens after the 2 months. Like all the vaccine producers are saying, it could mean that the vaccine lasts like a year, 2 years, and you need a booster shot, maybe not need a booster shot. We don't know. Like, we just don't know. And because we don't know, it means that it is uncertainty. And uncertainty is good for the price of gold. If you remove everything, if you remove all, like, everything around it, like all the speculation on whether there's stimulus or not, gold has been gaining this year, right? It's been positive last year, it's been positive this year. On average, the yearly average is roughly 10% growth per year in the price of gold. It's not like a huge amount, it's a stable amount. And I think we're going to see from the beginning of this year to the end of this year, the growth is going to be 10%. And the next year, we will roughly see the same thing. As long as you didn't only buy at the peaks, you'll be fine. If you cost average everything out into small quantities and you bought across, like I say, 4 months, 5 months, you're fine. I think you'll be fine. But if you try to back up the truck at any specific point and you missed it, you gambled, and you're not going to be that great. It's going to probably take you 3 or 4 years before gold climbs back to the level you bought it at, if it ever does. And yeah, yeah, that's all I have to say. I think it's interesting to know that, like, right now, I would say that there's a lot of indicators that are saying that we're kind of a little bit in the oversold territory. That's the most important thing I'm reading out of this, is that we're approaching an oversold territory, and there's a slowdown in terms of how many sellers are entering during a 9-day period compared to previously. Before, we were in a much more stronger bearish indicator, and now I'm seeing that the indicators towards sideways trading is a little bit more consistent. And I think we will stay around this range. That is sort of the, maybe I might be wrong, but I think it will stay above the 1800 range and below the 1900 range. And we'll be trading sideways until we see a change in either the stock market crashes, and then we'll initially see a crash of everything, or we'll see stock market improvement. Maybe by tonight when I release the video, stock market would have crashed. I don't know. Hopefully, I don't wish people to have a stock market crash, because anytime we have a downturn, you know, it's horrible. It's horrible for everybody. It's horrible, except for the guys who shorted the stock market, but there's only a few guys doing it. And of course, like, we see the few survivors of the people who shorted the market. But a lot of people short the market a lot of times, and they lose their life savings doing it, and they don't succeed. So this is survivor bias. We only see the ones who survive the shorting. We see it, if you want to see the corpses of all the people who had tried to short the market and succeed, you just have to go on to Wall Street Bets, and you see all the people playing with options and losing hundreds of thousands, 200,000, $1 million worth of their life savings in a year or 2 years because they made the wrong bets. And if you take the number of those people, the ones who made the wrong bets versus the number who made the right bets, you can see there's many more people who make wrong bets than the ones who make right bets. And yeah, it's a very ruthless type of situation. So do I think that you should, but it's a little bit different when you're trying to do long-term sort of preservation. Overall, if you're doing long-term, you're pretty much safe. But you know, you have to survive that whole time, which means that you can't go in too much, and it's not as exciting. It's less gamey, you know, it's less of a gambling aspect. So what I think you should do, well, for me at least, I can't say what you should do. I can say what I'm going to do. I'm still going to buy gold. I am going to, typically I buy a fixed amount at every paycheck, and I'll buy gold, I'll buy silver, and I'll be ordering my my Christmas gold and silver for the end of the year, probably sometime next week or next month. And if gold is lower, then it just means that I can buy more of it. And that's how I see things. And yeah, thank you for watching. If you like the content, click like, and please subscribe. I post daily content, so there's something new coming out every single day. And leave a comment below. I like talking to you guys. It's always interesting. I always learn new stuff, and I see that, you know, there's always viewers with new channels joining and saying like, look, I started stacking. This is my new channel, and yeah, I'll subscribe. Like, if you comment below, I'll subscribe, and feel free to sub too. There's new videos coming out all the time. Thank you very much for watching. This is Dave out.